Over the last couple of days, the paper gold price has dropped over $100 an ounce, but gold miners are actually in really good shape as long as the oil price does not rise too much. Gold miners are still, according to their Q2 earnings announcements that have recently come out, making record revenues, earnings, free cash flow, and profits. So earlier in the year, the larger precious metal royalty and streaming companies like Franco-Nevada and Wheaton Precious Metals, they were benefiting, whereas the gold miners, we hadn't started to see the top and bottom lines and the free cash flow numbers explode like we have after Q1 earnings announcements and now Q2 earnings announcements. But Wheaton Precious Metals and the other larger royalty and streaming companies already hiked dividends earlier this year. Recently, we've had a mid-tier gold producer, Centerra Gold, increase dividends by 25%. We've had Yamana Gold increase dividends as well. The Yamana Gold has actually been, even though Yamana Gold had some balance sheet problems over the last couple of years, they had to sell off the Chapada copper mine, which had gold byproduct, and Sandstorm Gold has a copper stream on there. And that was at one point one of their best margin mines. But Yamana Gold has focused on dividends, and they've actually increased the dividends 4 times, I guess, in the last 12 months, a cumulative 250% increase over the period in dividends. But they also just recently hiked the dividend after the Q2 earnings announcement, another 12%. Even Barrick Gold, and this came out on Monday, Barrick Gold even hiked, and lots of people know my opinions on Barrick Gold publicly. The Gold Antitrust Action Committee has extremely well documented the problems with Barrick Gold and how they admitted in open court to participating in the paper gold price manipulation scheme many years ago in a federal court. And Barrick Gold wrote off an enormous amount of bad deals. They even bought a copper mine. So out of the 40 billion plus in bad gold mining deals during the last gold bull market, before the paper price was smashed and a bunch of other games were played, Barrick Gold had the largest write-downs, largest write-offs. And even Barrick Gold is doing well. Barrick Gold increased dividends 14% recently, although it looks like their costs are starting to rise a little bit. Hedge fund manager Tavi Costa is tracking how a lot of gold miners over the last 12 months, gold and silver miners, have actually not been able to do equity raises or have not done equity raises. And I would argue from the Nolan Watson and royalty and streaming company perspective, it's because the gold miners were not able to until recently. So now there's more equity available, whereas 6 months ago or 12 months ago, there was not nearly as much equity, especially at the terms available. Now, a producing gold miner that was pretty low cost and had a pretty decent balance sheet could raise $50 million, maybe $100 million, but not anything more than that. New Gold did raise last summer around $150 million, but there was a botched financing. I've covered it on other videos in the past where the investment bankers, after 6 weeks, could only break even getting out of their shares. So the net equity issuance number is a little bit misleading because up until the last 3 or 4 months, there was not a lot of equity available for a lot of gold and silver miners. So now there's going to be more equity available. You're starting to see more juniors raise capital to do drill programs. If the gold and silver prices either stay at these levels and gold's still above $1,900 and silver is above 25 when I'm recording this audio on late Wednesday night, then there's going to be the opportunity, if the metals prices stay at these levels for the next 12 to 18 months or go higher, there's going to be capital available then to start building new mines. Are we there yet? Maybe a couple new mines, depending on the project economics, maybe a junior like a Silvercrest Metals, which has an absolutely outstanding project, but we're not quite there where a bunch of new gold mines are going to be built. But the larger senior gold producers in the not too distant future, over the next, say, 2 years, maybe 3 years, are going to have to start replacing mined reserves. They're going to have to go and buy either producing mid-tier gold miners or juniors with large projects. So that's Rick Rule has talked about this a lot lately, but at some point we knew this was going to happen. And historically, a lot of the larger gold mining companies prefer to do acquisitions, mergers and acquisitions in a rising gold price environment. Unfortunately, the industry just does not do a lot of low valuation contrarian, counter-cyclical type of deals. Those deals are normally done by the larger royalty and streaming companies, where they're buying the assets for pennies on the dollar. They're buying a byproduct gold or silver stream on a base metal or copper mine. And finally, these are potential red flags for individual gold miners. Large capital expenditure CapEx bills for the last 4 to 6 years were delayed by many miners until higher metals prices to maintain existing mines. If you own individual miners and the margins and free cash flow are not where you expected them to be, if you're doing back of the envelope calculations with all-in sustaining costs and looking for free cash flow margin, as I've talked about in my mining stock education lecture series and other short videos in there under that playlist, that may be why. There may be hidden CapEx bills. And the capital in the past over the last few years was not available to fund some of these either upgrades for mines or just maintaining property, plant, and equipment, or going and maybe expanding the mill at a mine. So many miners, this is unfortunate about the industry. Many miners do not disclose these large CapEx bills that are coming due in the near future publicly, even in the tiny font of quarterly or annual reports, or in the footnotes, or in the same for the investors' presentations. I have read many hundreds of these types of reports, including management discussion and analysis sections as well, and these presentations, and they are not mentioned there. So investors have to ask investor relations, or if you have a chance to talk to management, maybe at a conference or on a conference call, about if they're going to be candid about CapEx bills. Now, occasionally you will get a disclosure where in an investor's presentation, they'll list the CapEx for the quarter. So it'll say some of the good companies will break it down by mine. So it'll say this mining CapEx was 30 million for this mine, and this one was 20 million, and this one was 50 million, and this one was 10 million. And we spent more money on a mill or drilled more in an exploration program. This one was a little bit more. But if there's a really large CapEx bill on a mine that's been put off, the management team tends to not want to disclose that. Yamana Gold was one of the few ones over the last couple of years that actually did do that, because there were upgrades coming for the Chapada mine that they sold to Lundin Mining. There was about $230 million in upgrades for the Chapada copper mine, which also has gold byproduct. And Yamana Gold at the time, over the last 18 to 24 months, they couldn't afford it. So they sold the Chapada mine, which was at the time their best margin asset, cash generating asset. And that cash is what allowed them to pay off debt on their balance sheet, increase dividends. So I guess overall it did help their balance sheet, although in the long run they may regret selling that, even though it was mostly a copper mine with gold byproduct. But it did have the best project economics because of the grades of copper and the low costs, all-in sustaining costs. But Yamana Gold was one of the few companies that I actually have seen where they actually were disclosing the upgrades that were needed, and that was one of their justifications for why they sold the mine to Lundin Mining for, I think it was $800 or $900 million, something like that. And if you want more warnings about red flags and bad decisions by management teams in the past gold bull markets, so from 2009, 10, 11, and then after gold and silver prices, the paper prices started to fall in 2011, and the mistakes that management made, I talk about case studies, an in-depth article for my Patreon account contributors last week. So if you want to join my over 1,000 Patreon account contributors signing up for only $5 a month, you can take a look behind the paywall and look at some of the case studies, and you will be given a guide of red flags to look out for if you own individual gold mining stocks. Now, if you own a gold mining stock ETF, like a Go AU, which is a basket of gold mining stocks and royalty and streaming companies, you don't have to worry about a large CapEx bill nearly as much because you're not taking as much individual company risk. If you own the larger royalty and streaming companies, you don't have to worry about that as much because the larger royalty and streaming companies are not on the hook for large CapEx bills like that. Once they make an investment into a royalty or a stream, that is pretty much it. They are not on the hook for any additional CapEx bills for the miner. That's the miner's responsibility. See what happens with paper gold and silver prices. But overall, I think this is a healthy correction. We'll see what happens to gold and silver prices. I think a lot of it is dependent on the Fed's official balance sheet. A lot of people are talking about where real interest rates went, but there was a really good tweet by gold fund manager Garrick Moran, and he was talking about how the 10-year US Treasury only changed a little bit. I think it went from about 50 basis points to 65 basis points. And a lot of people are saying that that justifies $100 or over $100 an ounce drop in the gold price. And I agree with Garrick, that does not justify an over $100 an ounce drop in the gold price.